Welcome to our deep dive into the Simply Good Foods Company's fiscal first quarter 2026 earnings call.
Yeah, this was a big one.
A really big one. This was a hugely anticipated event, and our mission today is to cut through all the noise. We need to figure out why, despite what looks like a very messy quarter on paper, the stock saw such a dramatic bounce.
It was a huge relief rally. And you have to remember the context here. Investor confidence was pretty bruised coming into this call. The stock was down, significantly year over year?
Right.
So expectations were low, and management delivered exactly the stability check that the market was, frankly, desperate to hear.
So the reaction wasn't really about celebrating the Q1 numbers themselves.
Not at all. It was all about the future, all about underwriting their confidence in the back half of the year.
That's a critical distinction. They basically bought themselves some time. So, okay, let's ground ourselves with the actual results because they did technically beat expectations, right?
They did, yeah. They exceeded consensus on both the top and the bottom line. Adjusted EPS came in at 39 cents.
Which beat the 36-cent consensus.
Right, by about 8.3%. And net sales were $340.2 million, just a hair ahead of the $335.9 million consensus.
So modest beats. I mean, the top line year over year was essentially flat. It declined just 0.3%.
Okay.
But the real pain point, the issue that really could have unraveled this whole thing was the margin squeeze.
That's it, exactly. While the beats got them the relief rally, the quality of the earnings, it suffered. And this is where we have to start the deep dive. The gross margin fell sharply to 32.3%.
Okay, let's put that number in perspective because it's easy to just hear a number like that and move on. How big was that drop?
It was staggering. That's a decline of 590 basis points year over year.
Wow.
Yeah. That's nearly 6 cents less profit for every single dollar of sales compared to this time last year. Even the adjusted number was down 540 basis points.
That is a massive cost headwind. So where are the specific culprits? What did management point to on the call?
Two main things. First, elevated input costs. And that was almost all about the runaway cost of cocoa,
Which had so many of their products.
It's huge for them. And second, they took a big hit, about $4 million from new tariffs that flowed through the P&L for the first time. The result of all this compression was pretty brutal. Adjusted EBITDA declined 20.6% to $55.6 million.
Okay, that looks really rough. So if your margins are getting crushed that badly, the logical move for an investor would be to sell, not to start a rally.
Exactly.
So the key to understanding this stock jump has to lie in management's response. And it seems like it was two-pronged. This portfolio split they call the barbell strategy, and then a huge signal on capital allocation.
The barbell is their whole structural defense. The total company consumption grew 2%, but that number hides a huge divergence under the hood.
Right. It's a story of two different companies almost.
It really is. The portfolio is split between two high-growth engines and, one legacy drag. The engines are Quest and OWYN. Combined, they generated 71% of net sales and drove double-digit consumption growth.
What were the numbers on that?
Quest consumption grew 12% and OWYN was up 18%. These are the brands that are supposed to carry the future.
And the anchor on the other side of that barbell.
That would be the Atkins brand. Its consumption declined 19%. Now, management is strategically shrinking that brand, so some of this is by design, but it's performing exactly as the expected drag.
But the real signal, the thing that let the market look right past that Q1 margin disaster had to be the capital allocation.
Oh, absolutely. Management basically made a huge leveraged bet on themselves. They put their balance sheet to work.
What did they do?
The board authorized an additional $200 million share repurchase program. And they didn't waste any time. They accelerated the buybacks, borrowing an extra $150 million during the quarter just for this.
So they actually took on debt specifically to buy back their own stock while the price was low.
Yes. And they're still well under a 1x net debt to EBITDA ratio. Year to date, they've already repurchased over 7% of their common stock.
That is an aggressive move.
It's a very loud statement. It signals that management believes the stock is deeply undervalued and, it structurally engineers future EPS growth. They basically saw their own shares as the best M&A target they could possibly find.
That structural engineering, it creates a powerful floor for the stock. Okay, so if the financials were a mixed bag, we have to look at the brands. The whole thesis here rests on Quest and OWYN pulling all the weight. Let's start with Quest.
Right, and Quest itself is a bifurcated story. The salty snacks, the chips business, that's the powerhouse. Consumption there soared 40%.
40%. Is that a real number or is it just easy comps?
It's a bit of both. It definitely benefited from easier comps, but the growth is absolutely legitimate. Retailers love this segment. They see it as highly incremental, and the household penetration numbers back that up.
Cool, what are those?
Household penetration for Quest Salty just passed 10% this quarter. That's up 220 basis points in the year. This part of the business is on fire.
Okay, but then there's the other side of Quest. The traditional Quest bar, their flagship product.
Yeah, the original protein bar consumption there was flat year over year.
Flat. That seems like the operational Achilles heel right now.
Management's word for it was unacceptable. They pointed to some price elasticity after they took pricing up, and also some timing shifts in promotions.
So how much pressure does that put on their plans for the second half of the year?
Immense pressure. The whole plan to get that bar business growing again relies on new innovation. They mentioned the overload platform and just better in-store execution. The salty segment is a huge win, but the core business has to stabilize.
Okay, let's move to OWYN, the plant-based, clean label leader. Consumption growth at 18% is great, but those penetration metrics you mentioned, they suggest there's a massive runway here.
That's the whole excitement around OWYN. It sits right at that intersection of plant-based and clean label trends. Household penetration is only 4.5%.
Only 4.5%.
And brand awareness is just 20%. That gap between awareness and trial, that's the whole opportunity right there.
So how are they planning to close that gap?
They're putting the full scale of the Simply Good Foods machine behind it. They're increasing marketing spend about double digits this year to over 10% of sales. They are investing heavily to push that awareness number up.
There was some friction in Q1, though. We saw net sales lag that really strong consumption number. What was the disconnect?
Yeah, that was mostly some internal housekeeping, lingering product quality issues, which they say are fixed now, and inventory rebalancing right after they did a big ERP cutover.
So changing the internal computer systems created a temporary shipping mess.
Exactly. Consumers were still buying it off the shelf, but the shipments couldn't keep up. They expect that to be fully behind them in Q2. And we should also see the first new platform innovation for OWYN this year, moving beyond just drinks and powders.
Interesting. Okay, finally, let's look at Atkins. Consumption down 19%, which was expected. But the strategic pivot here, especially around GLP-1 drugs, this is where the story gets really compelling.
Right. Most of that 19% decline was tactical. About 2/3 of it was them strategically dropping distribution at some key retailers. But you're right, the future for Atkins is all about pivoting around drugs like Ozempic and Wegovy.
They're positioning it not as a competitor, but as a companion tool for people on these drugs.
That is the key. You know, these drugs have side effects. Muscle loss, nausea. Simply Good Foods just finished a pilot clinical study, and the results were really encouraging.
What did the study actually show?
It showed that patients on GLP-1 drugs who also use the Atkins nutritional approach had better muscle mass retention, which is critical. They also had fewer side effects like nausea and headaches and better metabolic markers.
That's a huge piece of data. If they can leverage that science, it completely changes the narrative for Atkins.
And they're moving fast. New marketing based on this science is starting in the next few weeks, and they're already talking to retailers, pitching Atkins as the essential companion for any GLP-1 user. It gives a legacy brand a very modern, very real role to play.
Let's connect all this back to the investor context. This whole relief rally, it's all based on management actually executing this back half inflection. They reaffirmed their full year guidance, basically asking investors to trust them on H2.
It is a huge ask. Especially since they guided for Q2 to be the weakest quarter of the year. They're expecting Q2 net sales to decline between 3.5% and 4.5%.
So what are the concrete drivers that give them this confidence in the second half recovery?
They pointed to 4 things. 1, the full benefit of their pricing actions. 2, new distribution wins for Quest and OWYN kicking in.
Yeah.
And 3, the painful comparisons from the Atkins distribution losses. Those ease up after April. That specific headwind goes away.
And what about the margin recovery? We saw that 590 basis point drop in Q1. Where is the relief going to come from and when?
The gross margin is expected to improve sequentially all year. Q2 will still be down, but only by about 300 basis points. Q3 is guided to be flattish year over year.
So the big turn is Q4. Management is guiding to gross margin expansion of nearly 200 basis points year over year in that last quarter. But isn't that based on hoping cocoa prices come down? How much visibility do they really have there?
That 200 basis point expansion is the core of the bull case, and they addressed that directly. They said they have successfully locked in new, more favorable cocoa supply that really starts to benefit the P&L late in Q4 and into fiscal 27. So that relief is already secured.
Okay, that's concrete. That's not just hope.
It's locked in. Plus, they're expecting some tariff relief from new trade agreements. That visibility on costs is what justifies their back half confidence, even with whey costs going up a bit.
So what does this imply for their long-term margin potential?
Management basically said that the Q4 exit rate landing somewhere in the mid 36% gross margin range is a good jumping off point for fiscal 2027. So they see a path back.
All right, this is a deep dive, and it is time for our Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based just on the signals from the call.
And the signal here was loud and clear. They borrowed $150 million to effectively LBO themselves with that buyback.
So the pitch is what we're calling the leveraged Quest bet.
The thesis here is simple. You ignore the Q1 pain and you ignore the Q2 weakness. The whole story is now driven by two things: the operational momentum of Quest salty snacks keeping the top line stable,
And the aggressive buyback program acting as a powerful financial floor underneath the stock.
Exactly. The buyback guarantees EPS amplification almost regardless of what sales do in the near term. You are underwriting management's belief that the stock is dirt cheap. The market's reaction confirms that focus is squarely on that guaranteed Q4 margin snapback.
So the actionable idea, hypothetically, is a long position based solely on that capital allocation strategy. You're betting that the buyback leverage masks any operational volatility in the first half, making the stock a safe way to play the protein trend until the cost relief hits late in the year.
Right. So to recap, this quarter was all about a necessary relief rally. The core story is still totally bifurcated. You have this incredible momentum from Quest and OWYN offsetting margin pressure and the planned decline of Atkins.
And the two most important self-help stories were that aggressive buyback signaling massive confidence and the really timely science-backed pivot for the Atkins brand into that GLP-1 companion space.
Which forces you to ask one final provocative question. Management is betting that the momentum from Quest salty snacks and the financial engineering from the buybacks will be enough to bridge the gap until cocoa relief hits in Q4. So with Quest bar consumption flat, is the success of one high-margin segment, salty snacks, is that enough on its own to carry the entire portfolio until the second half initiatives finally kick in?
That is the ultimate question for the next few quarters. Thank you for joining us for this deep dive.